I'm really curious for you to take us a little behind the scenes. If you think about that first rescue that was made by 11 large banks just weeks ago, why wasn't there an inclination to step up and save First Republic a second time?
Well, it's always a sad day when you see a bank fail. But we are all very pleased to get the major source of uncertainty that was remaining from the recent bank turmoil addressed. And that is a good thing, because fundamentally the US financial system is sound. This is a case of a small handful of banks that were poorly managed, and getting this addressed is very important. When we stood up, I think it's a statement that the major banks, the 11 major banks in the country, in 30 hours, put $30 billion to work to buy the time to get the right solution and answer put in place. And that was our intention. It wasn't to provide the answer. It was to give the time for confidence to get restored and our regulators to do their job, which they did.
With First Republic being out of the way now, certainly that was the whale in the room, but what do you expect next in terms of any future bank failures or even hiccups down the road?
So I'm more optimistic around it. I do think the US financial system is extremely strong. The large American banks globally are in an enviable position. Our financial system has a particular structure to it. The large banks, the regional banks, the commodity and community banks. Everyone plays a different role. We play different scale, different customer bases, but it's a strong system. I am anticipating there will be some more consolidation. We do have over 4,500 banks, and it's likely that the minimum efficient scale will rise, but I don't think that brings into question a system that is the envy of the world. This is a strong and highly desirable financial system.
With that works. Said, the big just got bigger today, right? This is JPMorgan rather than regional banks consolidating among each other. Does that create more competition for the smaller banks, given that the big are getting so big in this country?
I think there's room for everyone to play their roles, and the larger banks are also playing on a global scale. When I look at our own bank, our strategy is around being the preeminent partner for clients with cross-border needs. That is a very different role from the role that a community bank plays, which is also very important in the context of the local economy. So I think it's about different banks playing different roles, and let's make sure that we have a strong and successful system that works.
There's a lot of worries about the credit contractions that could be seen in the United States, particularly among that sector. Small, medium-sized banks that tend to bank small and medium-sized businesses. Do you expect that there will be a significant contraction, and how do you handicap the ripple effects to the economy?
So certainly the risks now are more to the downside than they were at the beginning of the year. And no one anticipated the turmoil that we've seen so far this year at the beginning. And I think it certainly makes the second half is not going to be as strong macroeconomically or in terms of investment banking wallet and the like that we had hoped. That said, I think, as you say, one of the big questions will be to what extent does credit tighten? And if that is material, that will have a drag on the economy. We're anticipating a recession at the back end of the year, but the amount of pent-up demand, the amount of the strength of the corporates, the strength of the consumer coming into this, the usual amplifiers of a contraction are not in place. And I think we'll see the US economy, unlike others, pull out of whatever a recession environment could be pretty quickly.
So to the extent you see that recession finally come nearer, what exactly does it look like? Who is impacted? What feels the pain?
Well, I think we'll see, as one always does, more pain being felt among some of the consumers at the lower FICO. The benefit we've got at the moment has been very strong employment, and that's terrific for the health of the consumer, and that has remained. The same, the corporate sector is particularly strong, and I think that's why you hear so many of us talking about this being a more manageable, a moderate recession, if one does indeed come about, and one in which the economy should be able to pull out of it pretty strongly.
And to the extent that you're preparing for a recession, Citigroup itself has just written off a lot of credit card debt to begin with in the first quarter. Do you expect you're going to have to tighten lending standards even more for consumers and even corporates?
We're a long way from being in a situation where the credit levels are even normalized to where they are pre-COVID. So we're probably only 70% of the way to the pre-COVID levels of normal credit losses that you expect. So there's still there's a lot of room still to go before we start using the stress word. Citi is probably a little biased towards the prime. 80% of our customer base in the States is prime, so we don't tend to see the lower FICO as much, and there will be a little bit more stress there, and everyone's going to need to keep an eye on that.
I want to pivot a little bit here and talk about another area of stress that is being seen in one of the safest markets in the world, that is the Treasury market. Mm-hmm. You have a front row seat here to kind of the ripple effects that are being felt in Washington from the disputes around the debt limit. Yeah. What does that look like from your view?
Well, I think the market's starting to have a sense of humor failure around some of what's going on. So we've certainly seen, more than we have in recent debt ceiling concerns, an impact on the Treasury market. In the short term, the pricing for the June-September has definitely come down. The CDS market is seeing a sort of quite unprecedented widening there. So there is a lot more concern. I'd say the last week or so, we were seeing 3 times the volume of questions from investors, and it's still early, but it is a concern around it, and I'm not going to comment on what the politicians should do, not my place. I will comment on the consequences. This could be quite dire for consumers, for corporates, and indeed for the markets if this goes down to the wire or worse.
Well, you also have a very international view as the most global of U.S. banks. How does the rest of the world look at this dispute in the United States and invest in a Treasury?
As the last thing that the world needs right now, particularly in the markets. So, we want to see strength in the U.S. capital markets. We want to see confidence in what's going. The banking sector, very well positioned. The banks are very strong, as we see. So we're in a position, as we did in the pandemic, as we did in the turmoil, to be there to support markets, to be there to support our customer bases, consumers and corporates. So I think from that perspective, we're in a good position. But it is the last thing that the world and America needs, is to have a debt ceiling crisis.
What about when you look at the Federal Reserve here? The other cross-current here to the Treasury market is another big Fed meeting and the prospect of even higher interest rates. Where do you think the direction of travel is headed, given the level of inflation that is being experienced today?
Yeah, as you say, services inflation is painfully persistent. We've seen the goods inflation come way down. Supply chains are now in far better shape than they were. So it's really about services inflation and the tightness of the labor market. And Chairman Powell has been, and we need him to stay resolute on inflation. This is not good to have long-term inflation into the U.S. economy. Some is fine, but his resoluteness is something I think we can bank on. So we're anticipating higher than the market would like for longer than the market would like. There's so much pent-up demand in the market at the moment that it keeps wanting to get ahead of this, but that's just not where the economy is.
So do you think that the market is discounting the potential for higher rates for longer, and what does that mean for asset prices?
Yeah, I think we do. I think many of us here at Milken do believe that there is that, the market is too enthusiastic here, partly because the economy is so resilient. I mean, this is a strong, resilient U.S. economy, and that is part of the challenge. So I think we anticipate, a tough end of the year and a recovery in 24. From the market perspective, though, it tends to anticipate these things. So towards the end of the year, the market should be anticipating the recovery and in stronger position. It's just a little later than it would like it to be.
I just want to reset here for our global Bloomberg TV and radio audiences. I'm here with Jane Fraser, the CEO of Citigroup. Jane, I want to pivot back to Citigroup and your business plans. You had mentioned kind of the softness expected through the end of the year. How do you expect that to weigh on investment banking, and particularly not just activity, but jobs?
Yeah. Look, our corporate clients come to us with a four-way dilemma, and that's the cash that they have on their balance sheets are in good health. Should they be keeping as cash for a cushion? Should they be doing dividends and buybacks? Should they be paying down debt, because the debt they anticipate being more expensive for a little while longer? Or or should they be investing in transformation? Our pipeline in investment banking is bigger than it was pre-COVID, and it's big transformational transactions. There's a lot of pent-up demand. We're seeing it, a little bit more IPO activity and interest, a little bit more in leverage finance. The investment grade market's better. So this pent-up demand is building and building. I just don't think it's going to get released as early as we would like it to, and it certainly feels much more like the back end of 23 for all of us than as we'd all kind of been hoping would be early fall.
And what does that mean for the job story then? Do you keep the bankers on board until that comes back, or do you think you're going to have to make some reductions before then?
I think like every institution, you make some adjustments around the capacity, but we're playing the long game in investment banking. I'm very delighted to say we have a lot of talent that wants to come and join us, and we've been bringing some terrific talent in the healthcare sector, in the technology sector, and investing in that. And yeah, we're playing the long game here, so I think that's important.
I think there's another part of the business that's worth talking about. It's your treasury and trade services business here. A lot of people don't realize you move $4 trillion worth of money for corporations and clients around the world. But how do you get the market to value you for that?
Yes. So this business is a thing of beauty. It's for 5,000 multinationals, $4 trillion every single day in payroll, in cash management, in procurement, in supply chain. It's also very, very sticky, which is, I think, of note at the moment, because there's a lot of services attached to it. There's data, it's embedded into the client's businesses, into their technology systems. It helps make them more efficient, manage risk, manage what's going on. So this is a highly desirable, very, very sticky deposit base that sits there. And I think the market's beginning to realize that this is a thing of beauty that has absolutely been firing on all cylinders as we've been investing behind it in the last few years. It's unique.
Is this the race that you're going to win at? Because the beginning of your tenure was really marked by exiting certain businesses. So what is the new Citigroup story to hold on to kind of bring that stock in line with performance of your rivals?
We have never been clearer about what our strategy and our vision of our firm is. It is the preeminent banking partner for clients with cross-border needs. It's a focused set of businesses that connect very well together with strong synergies. It's a better quality business mix. It's diversified. It's resilient, with a very, very good balance sheet beneath it. This is 90% of our credit is investment grade internationally, 85% of the corporate credit is investment grade, and our consumer business is prime. So it's a strong balance sheet off the back of a business model that is resilient, and we'll be there to meet our medium-term targets. So we're on a very clear path. We know exactly who we are, we know what we need to do, and we've been getting a move on getting it done. So I'm pleased with the progress, but we've still got a bit more to do.
One piece of the puzzle here is also the Banamex business as well. What's taking so long? At what point does this become a sale or an IPO, and which is more likely?
Yeah, well, we're in the middle of fairly active dialogue, so I won't go into detail there. We're following a dual path in Mexico for the consumer business. Our corporate business is thriving in Mexico, and that remains with us. It's quite a complicated separation, as you could imagine, of the two banks, and we're going about that in a very disciplined manner, making sure that we do this responsibly. And either way, we will be exiting that business with a clear path, but we're going about this with a dual track at the moment.
Now, if you looked in the Citigroup presentation from the last quarter, a few slides in, you saw a little footnote about the 8,000 people you've hired for technology, so clearly Citigroup is going through a transformation, but I want to look to future technology. How are you thinking about the renewed interest around AI brought on by ChatGPT?
Look, this is a game changer, and I think in a way when we look at blockchain and some of the other technologies that have come in the last decade, they've been part of the toolkit, but I think we're all beginning to realize what a transformative nature that generative AI in particular could be. It's early days because we have to understand what does this mean in terms of jobs, what does it mean in terms of business models, but this is certainly the one that all of us, the leaders in the industry are looking at and recognizing that there's incredible potential here.
What are the areas of finance that you think that it has the biggest impact to disrupt?
It's almost all of them. I think it can impact middle offices. It is and will be impacting trading businesses. It is and will be impacting really every dimension of finance, as it can do almost every client industry. But as we've seen with crypto, as we've seen in other areas, you need to have a good system of guardrails. You need to understand the ramifications and make sure that this realizes its full potential in a responsible manner, rather in one that can cause some unnecessary disruption.
Now, when it comes to, you said trading, and there's been a long push to electronify fixed income trading in particular. Do you see meaningful ways that it could finally change that business?
Oh, I think we've seen fixed income transform over the decades, and it's an incredibly dynamic and vibrant business. So it will yet again transform itself. Our own business is very heavily corporate-based, so we tend to see this in terms of what are the potential it can do for our corporate clients in providing the foreign exchange, the risk management, the hedging, and other potential for them, rather than really being a franchise that's just the pure trading. We're much more client-driven, so it's really around what's the potential value added we can give to our investor and corporate clients.
Now, before I let you go, I want to kind of weed out some of the talk we've had here at Milken, this whole thing underpinning this idea that 12 years of easy money cannot easily be unwound. And we have seen many hiccups already in the markets. But do you think that we have seen the brunt of the pain?
I think we probably have, although there will be a few more to come, I suspect, because particularly if rates continue rising, those that haven't done a good job on asset liability management will become evident. And we've seen that happen in the banking sector. We saw that in some of the issues with LDI in the UK earlier in the year, like last year, and we saw it in the exchanges. So you do tend to see where people have had weaknesses, particularly asset liability management, coming to the fore. The rest of us have managed this responsibly, prudently, and anticipating it.
What keeps you up at night of all those issues?
Cybersecurity.
Why is that? Is there something?
Because I think the level of sophistication on cyber attacks and some of the geopolitical tensions that are out there around the world mean that there's a lot of sophistication behind that, and it could be very disruptive in the system. And I think that's why you see the leading banks and the leading institutions putting a lot of resources and capabilities to make sure that we keep up with this and make sure America and the financial system is safe.
And lastly, just in a minute here, Jane, to the geopolitics of the cybersecurity issues, to the many risks you've drawn out, is there anything that can really change your view of this mild recession going into a deeper one?
Yes, if something happens on a geopolitical front, none of us anticipated the war in Ukraine last year, and that had major impacts, second and third order impacts on energy security, on food security, and the other pieces. So I think we've all learned never to say never anymore, that nothing will surprise us. So if something happens on that front, that could be very challenging. Let's hope that sane minds prevail.